It's common knowledge that markets around the world go up over a period of time, but what happens when the odds go underneath 50% or even get underneath 1/3 of the time? Well, as it turns out, with the 5 trading days locked in for the start of the year, and of course, Christmas rallies not coming through near the end, we have some interesting stats for January, and it looks like things are just going to get more volatile. With big moves in the NASDAQ moving into this week's big events, and of course, key levels for day traders to be looking at, it's sure to be one where you want to be setting alerts. Today, we'll take a look at all of the alerts for the major big market moves, and of course, we'll be discussing the first hit. Bitcoin finally made it to one of our biggest target points that we've had now for over 4 months. So, what's in store next? Join us as we cover markets around the world. Well, welcome back everybody to the Daily Show where we talk about markets around the world. My name's Tom and there's a lot to discuss in today's video because we're bringing you the biggest CTA, dark pool, and of course, the big trade data that's moving forward for January. But let's talk about the Monday session because it was up big time and markets failed to get underneath those 47 for 46.80 lows that we discussed in the previous video. We'll get more into the charts later on, but of course, Nvidia was the standout along with most of the Mag 7 stocks finding a bit of relief in what has been a pretty brutal sell-off. If we take a look at the 5-day average, you can still see here that markets really were suffering. Healthcare, utilities, and biotech were the best. But in the last 24 hours, it was all about tech and semiconductors up big time and making moves ahead of the biggest news. Remember, volatility is set to spike Wednesday, Thursday, and Friday this week. So could this be the calm before the storm, or is it just a big rally that's going to mean new all-time highs are coming for the market? I'm interested for your opinion. Let us know in the comments down below. Also, a quick reminder, this week kicks off our free VIP weekly newsletter return for 2024. Make sure to sign up. Links in the description down below. It's super easy. Name, email, and you're done. CTA equity implied notional flows. Now, a lot of people have been asking me whether CTAs are going to be a big part of 24. I think they're going to make up part of your checklist and you'll want to be looking at them. You can see here how they really dictated so many of the moves in 2023. And of course, when they start to sell right around that kind of August into September period, we needed to be paying attention because of course that led to further selling and then a huge switch around in October of 23. Recently, they've started to go a little bit more negative. They hit kind of those real peak areas where they tend to be a little bit overbought and they start to sell off. And this is maybe part of the reason why we've started to see selling. We've already reported on this movement back towards the negative side for CTAs. And of course, we'll be updating you here on the channel. So make sure to subscribe for that. But we've also talked about Goldman Sachs' main kind of lead showing you that it's been quite overbought. And in pretty much all scenarios in their models, it was neutral to down or down big time. At the moment, we're probably seeing a little bit of neutrality from the CTA models, at least ahead of the big earnings data coming out this week. So let's talk stats now. And of course, we've been mentioning the Christmas rally and the different stat points that can dictate a lot of January. And we've just seen some lock-ins. First up, the first 5 days of the trading year. They turned out that they were negative. Even with that big rally, it wasn't enough to overcome the negative first 5 trading days, and we ended up with a negative 0.4%. Now, this is one of the lowest reads. You'll notice that usually we get a lot more negativity when we get these particular reads for the first 5 trading days. That day did really save it. However, the Santa Claus rally also ended up being negative at negative 0.9%. That's the one after Christmas Day into the first couple of trade days of the year. And when we've seen similar stats such as this, notice January. What a negative period. Now, markets generally tend to be more towards that 50 to 60% bullish over a period of time. So 27.3% bullish over January is certainly a pretty worrying stat. Now, of course, it's just a stat by itself and price action will need to ensue. And we'll look at the key levels later on in today's chart together at some of the breaks that we need to see here. But yes, here's the first 5 trading days by themselves. And again, you can see why it's so important generally for January. And also it can be important for Q1 and even the rest of the year. Quite a lot of data points here. And it does tend to lead into a very volatile time over the Q1 period. No surprises if you know your stats to do with presidential elections as well. We'll post that over on our X, so make sure to go follow us over there if you're interested in having a look at that chart. Let's talk other stats moving forward. Of course, the Grinch, and then we have the stats moving into the first couple of trade days of the year. And you'll notice that we tend to lead into kind of negative periods over Jan 7th to 14th and Jan 14th to 21st. This is where the volatility is set to really be its highest, and it makes sense leading into earnings season as well. If we're going to see selling, that's generally where we want to put it. Now, a lot of people are saying, well, it's because we ended an 8-week plus winning streak. It's overbought. Yeah, that's true. We certainly have become an overbought market, but just because we end an 8-week winning streak doesn't mean markets will go down. You can see here Wayne's done some great analysis on figuring out that actually markets tend to actually drive higher after such periods of time. Now, this is not taking into account the first 5 trading days and, of course, everything we saw with Christmas kind of fail at the end of 2023. But in general, when we do tend to see these huge, really robust kind of big rallies that go up and up and up and up and up, we usually go more to the sideways down and then actually start to rally back up from that point. Price action will, as always, dictate a lot of what we're going to be seeing moving forward. I also wanted to bring in some positivity for the year as well. Of course, January might look a little bit negative. Maybe Q1 might be negative as well, or at least tumultuous. But at the same time, what tends to happen in years such as this? Well, funnily enough, if we have a midterm year that's down, which is the middle of the election cycle, of course, 2022 in our case, then we tend to usually see very, very strong returns. In fact, pre-election years are up every time, 100% of the time, and election years have also been up 100% of the time. So what happens here in Q1 may also be an opportunity for bulls to get into cheaper prices. And I think a lot of that is starting to be stacked in. Another one is, of course, the toy 2-month stat, which we'll be looking at, which can tell us a lot about strength as well, leading forward for the year. And if we get a really strong read on this, we end up getting a bad January and Q1, then we start to see some positive price action. Well, I think we'll know that usually the bulls are going to win, and it's actually the normal thing that tends to happen. What about recessions? In 1990 and 2007, it took a year and a half for stocks to plunge as recession hits. Yes, it usually takes a while for markets to actually sell off. So just remember, if we end up getting a recession, that recession leads into a market sell-off. It's not going to be just like oh yeah, let's go buy the dip style scenario. It's generally going to be a fairly long-lasting kind of sell. Now, I don't think this is going to be the way it plays out in 24, but interestingly, this is something that is here. And do remember, one of the lead stats you'll be looking at in 24 is going to be the US 2-year, so 02Y versus the US 10Y. When that uninverts, you're going to need to be most concerned about the markets. It's not even close to doing that just yet. So for now, we don't need to worry about that too much, even though everybody's talking about it constantly. Let's now discuss 0DTEs because, of course, 4,700 held, and it meant that we didn't need to move down to 4,600 just yet. It still stands pretty much to reason that 4,800 is a bit of a key call wall or a top end. 4,700 is where we get the most amount of activity and where the markets like to gravitate to, you would think. And 4,600 remains the area if we break underneath 4,700. We'll show you the alerts on this later on in today's video, but it's still like that for the options market. And 4,800 could be a gravitational point moving in the next couple of days. Let's talk Russell 2000 as well. So generally we see seasonality towards the Russell from kind of like that November 11th or December 11th period all the way through to February, and it usually outperforms the S&P 500. Remember, we spoke about this, which is, of course, the end of the year, tax loss harvesting, taxation in general, profit taking, all of those types of things that Wall Street wants to do and the big funds want to do. Well, that's kind of over now. So the Russell has no excuses but to try to get up if it's going to hold those stats. In general, you can see here the percentage of days with positive gains remain very, very strong throughout the rest of the month for the Russell. So we'll be looking at price action very closely. Some other people brought up this after Friday. Here's a different chart, which obviously shows you JOLTS total job vacancies versus, of course, the S&P 500. And as you can see here, we've disconnected from, let's say, the reality of jobs. And this is a lot to do with the Fed, what it's trying to do in terms of slowing down the jobs and slowing the economy. So it's kind of like a strange time. But you can see if you put this stat together for a long time, it tracked really well with the market. At the moment, it's broken, and I think it's expected to be broken, to be real. So a lot of people throwing that chart around. I don't think there's anything too interesting there. What about this from Bank of America? Just interesting to see the industries that are investing in AI investments and the ones that are not. No surprises, banks are not investing as much as you would think. And of course, real estate just doesn't care. So real estate, actually AI investment is incredibly low. And it just shows you here that the industries that tend to be on this end will have a lot of, I would say, volatility in jobs in the future. And it seems like some of these jobs, maybe there won't be as much volatility from AI, at least initially. Interesting where the big spend is going. What about earnings season? So, of course, this year is big, and earnings has been one of the most important factors for the markets in 23 and continue to be in 24. We mentioned that earnings needs to hold up. So Apple's ratio of buy ratings is dropping. A huge reason why we saw that recent 9% sell-off is because we're seeing a drop-off in the amount of people showing buys. Here is a relation between the markets and, of course, seeing earnings growth and multiple growth coming through, and therefore wanting to actually have a strong market. We need that earnings growth. You can see here 2021 was all about earnings growth. 2022 was all about weakness in growth. Then we had a really good 23 with surprise results. And 2024 is shaping up to be important. We need earnings growth. If we don't get it, I think markets could be in for trouble. So expect volatility. We already saw Crocs just come out with a big announcement saying that they're doing okay. And the stock was up 20% in one session. So it just shows you that earnings is going to be very volatile this year, and don't discount it this January. Let's talk banks, because of course that's where it all kicks off this Friday. We've got some big ones, JP Morgan, which considered to do pretty well. Then we've got Wells Fargo, Bank of America, and Citibank. Now, all of these are expected to move quite a lot, but it's particularly Wells Fargo, Citi, and Bank of America that, according to the options market, could move plus or minus 4 to 5%. So if you're looking for volatility, these are the banks that are going to usually have it, and JP Morgan is not going to have as much. It's been doing very well recently, and all banks find themselves close to resistance into this key break event. Now, if we get breakouts, of course, markets will probably continue to rally up. But if we fail with things like Goldman Sachs, JP Morgan, Citi, and others, then we're probably looking at distribution on a lot of those charts, and therefore further sell-offs coming. And a lot of that's coming back to things like these types of indicators. We already talked about Q1 often being kind of seasonally weak. It being a period of time in an election year where markets will go like this. And then they'll start to rally back up through the middle of the year. Well, dumb money confidence also suggests as an indicator that this could be true. We saw this read about 2 weeks ago, and since that point, we are a little bit lower. And you'll notice that we tend to lead into 3-month pullbacks over this period. Now, it doesn't mean they have to be brutal pullbacks, but it does generally lead into volatility. So dumb money confidence is high, sentiment is high, everybody's been buying. And at the same time, we just need to be cautious around this period. Everything was super bullish up until kind of the last week of December. And now the muddy waters are around. So earnings better represent for markets to be able to get to those 4,900s and 5,000s on the S&P. Here are some positive signs again for the bulls moving forward in 24 though. We haven't seen too many of these reads before, but momentum obviously coming with the NASDAQ throughout the back end of 23, and similar reads such as that in early 2000s and just after the global financial crisis led into really nice bullish periods. And I still think that the outlook for 24 at this stage remains relatively bullish, with Q1 really being the major concern. Let's now go to options market. Did we get a big day? Well, we did. 40.5 million versus 39.2 on average, 57% calls. So calls reigning supreme again when it comes to the market. And you'll see some big trades were coming through. This Verizon trade was massive, 24.58 times normal volume, all in calls. And we also saw the SPY get a slightly higher than 90-day average with a lot of puts that were stacked onto it. So that could explain as well why markets went to rally. Maybe too many people trying to go negative without that further confirmation. We'll look at that on the charts. And speaking of charts, let's get into it straight away. So first up, did we get any movement in central bank liquidity? The answer is quite simply no. So we'll skip over that one for now. We'll come back to it if we do see any switches. What about the US 10-year? Well, it dropped back down. And of course, we've been talking about this 4.2%. I don't think that's lost on the market just yet. 4.2% is the 20-moving average. Obviously, at this stage, we are above the daily 20-moving average, which is a bit of a split in terms of where we've been. and we actually held up pretty well in yields. I would expect CPI to be the catalyst for something like this, and maybe even some volatility coming into CPI that could push us up. What we're really looking for in this market at the moment is mean reversion. Now, why would we be looking for mean reversion? It's just a standard pullback that means the market's a little bit healthier. If we just keep going up and up and up and away, and it just keeps going, it blows off rally really massively, then that can lead into very serious times in the market. So if you're actually a big bull, you kind of want this technical mean reversion to occur. What about the percentage of stocks above the 20 moving average? Well, we still see that in kind of the middling zone. I'd like to see it come back down to 25. That's usually where you start to get into some nice technical levels in terms of pullbacks, etc. So yeah, we haven't seen it there, and breadth still remains really good because, of course, percentage of stocks above the 200-day remains incredibly nice at this point. Treasuries were rallying thanks to yields across the board dropping off, and we didn't really see too much movement here. I guess we're still going to maintain that treasuries were more likely to be sold during this period, and we think that this is still an area of interest. 94, 93 on treasuries, something we'll be looking at, with a nice little uptick there, I guess, for the bulls in the last 24 hours, but still, I think, a bearish tinge on profit taking at this point. High yield junk bonds, corporates, any of these types of things were up thanks to yields. But we did see, of course, some of our lead indicators showing us that bonds were a little bit more, a little bit less healthy, you would say, in the start of 24 so far. First home builders, well, that was up on the session. You can see here a nice little rally back up, filling in almost some of the gaps. And of course, Dow Jones Transportation Average as well, something that we always want to be looking at, did manage to make a little bit of a spike, but it's still got a double top in play. So of course, we have the high here, we have the breach down. We certainly haven't come back enough yet to really say this is broken, and it's still holding as well below the 20 moving average. So it's kind of pointing towards further sell-offs being very possible here in the markets, especially if the volatility kicks off with those big CPI numbers and earnings. Let's move over to copper. How's copper looking? Well, it bounced off the 20, no breakout to the upside, so not too many reads here. Still looks a little bit crappy on the charts. Dollar index, bit of weakness here. I think day traders, if you've done something like a day trader masterclass, you might have been trying to short in here for the dollar. Fair enough too. That's not too bad a zone. Around here, you'd be looking at break evens. So you're pretty much looking at that break even kind of side from the day trade perspective, or maybe even some profit taking in here. But in general, this market remains kind of sidewaysy, and we did fill the gap, but 104 could still be on the cards. And I think it's going to be news catalyst related. So I wouldn't expect maybe the dollar to lose too much here. I could see it kind of maybe go 101, 25-ish zone, and then we might be sitting there or even sitting at the high resistance before the big CPI number. Let's move over to gold now. This one broke underneath most traded zone. It looks like gold could go down to 2003, which would be still, I think, a very interesting level for the bulls. And it's more of a muchness for gold. Since we got that big blow off over here, we've basically tended into a sidewaysing market, which is exactly what we expected back early in December when that whole blow off happened. Unfortunately, that led into what usually is a stat with a month of sideways style action. It's exactly where we are right now, and it's what we expected. Oil, not too much going on here, did drop off over the last 24 hours, still failing to break that huge trend line on the way down and the downside. Obviously, the most traded zone sitting around 75.80. And for bulls, you're going to want to see exactly where it is right now met by buying demands. This is exactly where you expect bulls to be, and pretty much anywhere in here is where you expect bears to be, with area changing in between here being the most kind of like skipped over level. And that's a lot of what trading is. It's moving from equilibrium to equilibrium point, and you just need to kind of figure out where those gaps are so that you can get those large moves from one point to the next point. At this stage, this is where the bulls are though, so we're looking for small price action. I don't think oil has an easy trade on at the moment, but certainly is there. Let's move now single stocks, and then we'll go into the indices. Straight up, we are looking here at a bit of an anchored VWAP kind of level, and also, of course, a previously accumulated zone. We still didn't get bound to the perfect zone, which would have been about 234 for Tesla. We ended up getting to 234 or 235, and we've had a lot of buying around this level before. So we got this bounce. The daily here is closed above the long leg doji, which is kind of I guess you would say significant, but you'll notice I have an alert set here at 243-ish. So if we manage to get through that zone, I could see like little day traders kind of trying to push Tesla up. Day traders pushing into something like a 250 from that point as well. So having that kind of almost $5 to $6 kind of price range in day trading action. And at this stage, you could just say this is where the accumulators are. So it's where we expect buyers, but not really a super strong move just yet from the Tesla traders. Apple was a little bit better. We did see a bounce up. It did come out of the gates fairly strong. You can see here a gap up after a gap down. There is case to be said that this could have more further rallies on it. I don't think it's a super strong setup again. I would have preferred getting down to the most traded zone and setting up the way we were talking about, which is sideways, dump into the big news event, and then rally back up. I like to really buy V's more than anything else. And in this case, it's kind of not really the perfect setup in my kind of eyes. It does look okay if you really like buying Apple at cheaper rates. And down here, I guess you're getting a 9% discount. The other thing that's notable is that if we keep rallying and we end up seeing a nice pullback from Apple, when it gets back up to this watch zone for bears, we've just adjusted that based on some analysis we did over the last 24 hours. And this area here seems to be a new update for that point. Let's move over to the German market. It's holding its own. It's still either in distribution or a huge accumulation. We don't know yet. And we are being patient on this one. So obviously a huge pickup. What this is right now, it's burning time. So this is a pullback in time. And you'll hear me mention that a lot in 24 because a lot of people think sideways markets are not pullbacks and they're just kind of like nothingness. Well, they are. They're pullbacks in time. And remember, in many ways, you are trading time when it comes to the market. If you think about the S&P 500, where it was 2 years ago and where it is now, it's basically the same price. So you might say, well, it's not cheap. It's expensive because it was expensive back then. But you've also had 2 years of partial growth in the economy. So therefore, it's a pullback in time still on the markets. It's a good way of thinking about it when you're looking at price action because sometimes people look for really big pullbacks. You're not always going to get that. Sometimes you just get these consolidations instead. All right, let's move over to the Aussie market. You can see here, big resistance still being resistance, no breach out above that. So really no changes here. It's going to be dictated to a lot by the American market. So let's talk American market now. And first up, the Russell. I don't know if I've really changed my opinion that the Russell can get down to 1860. I still think this is the more healthy pullback level and the more likely one during January based on the stats so far. But timing will be everything. So you don't have to trade down to it, remember. Instead, what you can be doing is looking for those levels. If they hit, if they then show the right types of setups, that could be something that you're looking at on charts. Russell 2000 finding some gains in the last 24 hours, but still much weaker than something like the NASDAQ. Now, I've written here, watch the reaction here, because the NASDAQ actually came back to one of my classic style setups. And I don't know what's going to happen just yet, but this would be kind of a day that I usually would be looking at day trading. And what I would do is I'd break down the smaller time frames, such as the 15-minute chart, and really be interested in the interaction with this level. How is the market interacting with this level? How is it building up? Does it breach out early in the session? Does it then dump during the mid-morning and then rally a little bit? That could be something that I'd look for towards the short end. And it's because it's actually a key level for that. And you can see here you've got a little bit of supply on the left-hand side as well. Big rally, no doubt, a lot of pickup in the markets. Looks like a really nice bull kind of pickup, and everyone's, of course, getting excited again. But it's come back to where I would say the NASDAQ is the most likely to actually have issues. And it might not look obvious on the charts, but this is the kind of level that I usually do look at. And it's all about now having patience to react and not predict. You might say, well, I'm looking at it. Doesn't mean you have to trade it. If it shows the right setup, then you could say, okay, well, in this circumstance, I believe I have a statistical advantage or whatever that might be. That's what your trading system has to be in 24, 25, 26 moving forward. You are dealing with replicable concepts. That's what you have to always think about. If you go over and you think, wow, what am I going to do with Mara? Well, is Mara a replicable style setup, or is Mara going to be more of a risk because it's not necessarily got the history on the charts, et cetera, et cetera? Think about those things. I think it's going to be very important for a lot of retail traders and us out there moving forward. Let's now move S&P. So obviously we talked about the weakness in the previous candles, and if we breach past that, strength coming through. So here are the alerts. One of the alerts triggered off, which was 47.30. So I think 47.30, if you bought through that and you're sitting there right now thinking, yeah, look at me go, Yeah, sure, 30 points is pretty nice. It's not a bad movement up. And if you were focused on shorting the last session, remember it needed to go through this low. If it did go through this low, the chances of going to 4,600 to 4,550 from that point were quite high. Again, patience, react, guys. You cannot predict it. This looked bad, no doubt. 2 rejection wicks, follow through would have been really negative towards the markets. Markets obviously found a lot of puts. You can see that now that we've seen the options. And in the end, they said, well, more profitable to squeeze higher. Could we be going for a gap fill? 47.69, 46, 47.70 seems to be a big key area. We already know 4,800 is a big call option zone. So somewhere up here could still be where the bears are. And even though it looks pretty bullish on the charts, and no doubt the trend is bullish, so therefore you've got more chance of being right on the bull end than the bear end at this point from current structure that we're seeing. This point from this break here to this break here, or this level here, is probably the most likely kind of scenario. 4,900 could still be on the cards as well, especially if we breach 48, and then 4,900 would become the next level. But I'll be watching the NASDAQ actually over the next 24 hours. That's going to be one of the keys. Let's have a look here at the futures market action, just so you can see the new low did not get taken out during the trade action of the markets. This is, of course, the 47.30 level. We breach through, we move higher. We get into this possibility now, 47 kind of 80 zone, which is where we have that previous supply. And of course, we have a gap fill that's in here. So a lot of that does make sense. We breach back under though in the future, or even start to see shorts in here. I could see markets coming back down to the 4,700 zone. And they'll be pretty happy also to sit around 4,700 if they can do it for the end of the week news. So just remember, I expect volatility all over the place. We did end up making a lower low over here past those points. So because of that, when you get pullbacks such as this area here, day traders will be very interested in the next 24 hours of structure, particularly around this zone. And we don't always go down to a 15-minute chart on this channel, but this is a particular area of interest. Let's now talk Bitcoin. Speaking of interest, 47K. Okay, well, I'm going to say straight away, congratulations to anyone that's holding into this zone. If you've been following this channel now for many, many months, you would basically have heard us just say Bitcoin is still melt up, bullish, melt up, dull, all these same words. And you might think, well, that's super boring. But as I explained, and as we talked about in our Monday live session, which is totally open and free, remember, to all of you guys out there, we had well over 800 plus people, thousands of people coming in through the stream. Thank you for making 24 already a success with our live stream. So thank you very much for that. We're doing it again next Monday, a few hours before the market opens. So it's a pre-market session. So make sure to sub to check that out. And you can see here that Bitcoin hit that 47. So this is a very big zone. Between 47 and 50, we know that we're looking for market structure. That's actually towards the short end now. And the reason you might say, well, Tom, look, the trend's so up. It is. Do I know it's going to end yet? No. But this is a point of very, very big interest. So 47K has been hit. We know that we're in a halving cycle year. We also know that markets tend to get a little bit negative on crypto heading into the halving. And then after halving tends to be a lot better period for them. So we've hit it at around the right time. This would be where I'd like to see some weakness coming into the cryptoverse, and we're focused on this. Now you might say, well, Tom, the ETF. Sure, the ETF is one component of bullishness, and I am bullish on it over the long term from that aspect, but I think it could be a buy the rumor, sell the fact style thing. 20 moving average still remains the most important moving average when it comes to these charts. And just to kind of reiterate this, let's go back over to the SPX for a second and look at the 20. So you can see here the 20 kind of held up because we never got that closure underneath the 20 over here. And this is on the SPX itself. But do remember that that 20 on the weekly is the big key level. And the reason we're talking about that is because generally speaking, you get a lot of pullbacks to the 20 during nice big trends. And the 20 usually gives that kind of style of action and stuff. And it's not unusual either to see markets sometimes see these big sell-offs and then they kind of, just hodgepodge around until they get back to it. So you can see here that it can get a little dull, a little bit wild. And I expect January to be something like that. So gap fill up here, 47.70 to 47.80 is a key point in time. So Bitcoin, 47, nice hit. I think it's an interesting TP zone for a lot of price action based traders. And then from this level, we're looking for structural creation. Do remember this week is mostly about everything to do with volatility. We've got CPI coming through on Thursday, which is expected to hike up a little bit. So that might be a catalyst. And then, of course, we also have Friday, which is going to be those big earnings reports. Stick around for more videos coming out this week, guys. Remember to subscribe, smash that like button if you're interested in those types of things. And also our free VIP weekly newsletter coming out very, very soon to an email near you if you have subbed up. So make sure to do that. It's totally free to do so. Links in the description. Bye for now, everyone. See you in the next one. Bye for now.